Greetings, traders from all around the world. Thank you for joining me yet again for another Survival Guide episode. Today we're going to be covering cattle futures, which has had a profound effect as many things have had since the coronavirus pandemic began. As you can see over here, we had a tremendous fall off sometime around the beginning of March and have yet to break through the support lost, working as an area of resistance in the future. So we're going to dive into what cattle futures are, how they can be traded, as well as some of the strategies that go into trading cattle futures. So without further ado, let's get going. Cattle futures. Are we talking about spooky time-traveling cattle from the future? No, luckily we are not. Instead, we are actually talking about financial instruments that give the buyer the obligation to purchase a set amount of cattle on a certain date and for a certain price. This means that the futures contract buyer and the cattle producer can lock down a price in advance so they are not at the mercy of price fluctuations at the time of sale. Now, cattle ownership is a pretty significant investment. Therefore, producers need to be able to calculate their break-even points and lock prices in on their commodities for better price management. Instead of waiting and getting whatever price happens to be in the future, many cattle producers, a futures contract means to them that they can now mitigate risk to ensure they are still operating next year. So the majority of people out today that are trading cattle futures at the largest of scale would be our ranchers, our leather manufacturers, as well as small businesses. In the world of cattle futures trading, there are two types of contracts to choose from, and both of them are traded on the CME, otherwise known as the Chicago Mercantile Exchange. We have live cattle, and we have feeder cattle. The underlying difference between the two, being the feeder cattle and the live cattle, comes down to the age and weight of the cows. The feeder category comprises of cows within the calf stage, until they reach a weight of 600 to 800 pounds, that is. This weight gain period can take anywhere from 6 to 10 months after the cow is weaned from its mother. So we want to think of the feeder cattle as the cows that haven't plumpened up enough and still need to be fed more. So after the cows mature through the feeder cattle stage, the cows are then transferred to lots, which some of those lots can hold over 50,000 cows. That's a whole lot of cows. These cows then fall into the live category and are kept there in order to continue gaining weight until they are ready to be slaughtered. The largest producers of these cattle in the U.S. are Texas, Arizona, Kansas, Colorado, Nebraska, California, and Iowa. I don't think it's really any surprise to anyone that Texas has a lot of cattle because they have a lot of, cowboys. Hey, hey. Naturally, the survival guide wouldn't be complete if I didn't give you some reasons to consider joining the herd. See what we did there? So our first reason is going to be betting on global growth. The global economy and population are growing, and with it, the demand for animal proteins, including beef. The United States, China, and Brazil are the largest consumers of beef globally, while China, South Korea, and Russia are some of the largest global importers of beef. The growth of these powerhouse economies alone is enough to want to bet on continued solid expansion and profitability, especially when you consider the expected rising demand from emerging market countries as well as Asian markets. Our number two reason to join the herd is going to be hedging against inflation. Investing in stocks and bonds is a proven way to hedge against the loss of purchasing power due to inflation. The same principle applies to cattle. The steady rise in the prices of goods and services is ubiquitous worldwide. You can expect the livestock price to increase should the economy experience higher inflation. This is because meat and milk from cattle fall under the food category, which remains the most basic and fundamental necessity of humans everywhere. This means we might as well benefit from these expected inflationary trends. Our third reason to join the herd is going to be portfolio diversification. This means if you've been looking or considering less traditional investment forms or are looking to break into commodities markets, the livestock futures market may just be the ideal starter for you. It is a good way to diversify your portfolio due to a low correlation with the equity and fixed income markets. As we mentioned previously, live cattle futures are in fact traded on the Chicago Mercantile Exchange. The price is quoted in cents per pound. Various market players, including cattle producers, packers, consumers, and independent traders, all trade using live cattle contracts. The reason that this type of contract is so interesting and popular to all of these parties is it gives them an opportunity to hedge their market positions and reduce the notorious volatility and uncertainty associated with live cattle prices. It also allows market participants to assess and bet on cattle demand and supply in the present and in the future. Here we have the live cattle contract specifications as can be acquired from the CME Group's website. The contract ticker symbol will be LC, but as far as the electronic ticker symbol, that will be LE if you're looking. The contract size will be 40,000 pounds of live cattle being the underlying commodity over here. The price fluctuation will be $10 per contract, which is going to be somewhere around 0.00025 of a pound. The trading months will be February, April, June, August, October, December, and the trading hours will be Monday through Friday, 8:30 a.m. to 1:05 p.m. Chicago time. The termination of trading will be 12 noon Chicago time on the last business day of the contract month. So we don't have a whole lot of random breaks occurring with this futures contracts as we are familiar with others futures contracts that we have discussed in the past. As with any type of trading or investing, we should always be aware of some of the risks that might potentially present themselves in the area that we're interested in trading. In this situation, we're talking about live cattle future trading, so let's cover some of the top 3 things that we should be aware of here. Number 1 is going to be the volatile prices. Unlike with gold or crude oil like we've talked about in the past, the primary traders of live cattle are not speculators like you and I, but industry players looking to hedge their risk exposures. This means that sudden events like changes in feeder cattle supply, consumer demand, weather, among other factors, could lead to extreme price volatility. Then our number 2 risk we should be aware of is the healthier living and environmental concerns. The beef production process is heavily energy intensive. In addition, the Amazon rainforest and other forests are being cut down to make room for livestock. This only fuels negative perceptions about beef consumption as not only a poor dietary option, but also one that affects the environment in a poor manner. Number 3 on our be on the lookout list is going to be bovine spongiform encephalopathy, and this is going to be BSE, which most of us will recognize when I say mad cow disease. So known as mad cow disease, BSE is Known as mad cow disease, BSE is capable of crippling demand for beef products on a huge scale. Naturally, an outbreak affects the trading volume adversely, and cattle prices ultimately will plummet anytime there is a high mad cow disease scare. On the subject of feeder cattle futures, feeder cattle are crucial to the global ecosystem of beef production, and they are a vital commodity in the world. The industry is also responsible for millions of jobs. This includes suppliers, distributors, and retailers. Consumption of beef worldwide is teetering at around 60 million metric tons annually, and the economic impact in the United States alone means the meat and poultry industry is worth over $1 trillion. That is a powerhouse to say the least. One of the most appealing features of feeder cattle futures is that they allow traders to play an active role in the all-encompassing market, which includes price demand for feed grain and the cattle themselves. In addition, traders are able to address the price risk among those involved in the trade of feeder cattle for both the current and future outlook. Here we have a feeder cattle contract specification sheet. The contract ticker symbol will be FC, but the electronic ticker symbol will be GF if you're looking to type it into your platform. Our contract size is going to be 50,000 pounds or 23 metric tons. That is a lot of cattle. The underlying commodity is going to be feeder cattle, of course, and our price fluctuation will be $12.50 per contract, otherwise 0.00025 a pound. Our trading months will be January, March, April, May, August, September, October, and November. The trading hours will be the same as our other contract that we already discussed, Monday to Friday, 8:30 to 1:05 p.m. Chicago time, with the termination of trading occurring on the last Thursday of the contract month, with exceptions for November and other months. Just as we discussed the potential risks associated with live cattle futures trading, there are risks associated with feeder cattle futures trading. Boy, say that one 5 times fast. The first risk we should discuss is the open interest gap between live cattle and feeder cattle contracts. As the trade volume between the two types of contracts widen, increased vulnerability starts to set in. This is especially true with the weight of spreading and crush trades derived in the live cattle market, which overwhelms the feeder cattle contracts. This eventually makes price nothing more than a reflection of the direction of the deferred live cattle contracts. Then we have number 2, which is going to be fluctuations in feed prices. These include prices in hay, corn, and soybean. Any of these can directly affect the feeder cattle market. If the feed prices are too high, cattle are often sold at lower weights, which results in price drops for the cattle market. Then we have number 3, extreme weather. High temperatures can decrease the appetite of the cattle, which in turn reduces the amount of weight they gain while at the feedlot. This again results in lower cattle prices. As with all futures trading, having a strategy or a plan of attack is crucial to success. We have 3 different strategies in regards to cattle trading that should definitely be talked about before going forward. The first idea is invest in a diversified basket of commodities that includes the cattle contracts. So due to the large price volatility of futures, you'll want to think carefully before taking large speculative positions in the commodity. One good way to mitigate this risk is to invest in a basket of commodities that includes cattle, poultry, other agricultural commodities, metals, and energy. This approach can help us accomplish a couple goals. It protects our portfolio against inflation, and it also protects against the volatility of price movements of each individual commodities. Then we have number 2, which is to look for imbalances in the prices between live and feeder cattle. The prices of live cattle and feeder cattle are highly correlated, which often leads to traders trying to profit from the spread between the two. For instance, some traders capitalize on the price spread between live cattle and feeder cattle, as well as the price of corn and hay needed to feed them. So what traders often do is buy live cattle and sell futures in feeder cattle and corn. Now, this is definitely a sound strategy that can also lead the trader to benefit from price discrepancies between the two types of cattle. Feeder cattle represent future supply, so any disruption will most likely influence the price and the demand for live cattle. In the event of live cattle oversupply, the price for new cattle coming onto the market will also be affected. And then number 3, we have trade in meat production and processing stocks. If you'd rather skip the nitty-gritty that's involved in just directly trading the asset of cattle, live or feeder cattle futures contracts, you have the option of marginally being invested just down the line by trading in meat production and processing stocks like companies such as Tyson Foods or Cranswick. There's a bunch of companies out there that are indirectly related to the value of the feeder and live futures cattle contracts. And trading in them will give you a way to be involved with the market without being directly involved with some of the higher volatility aspects of live and feeder cattle trading. Here we have a chart to help us illustrate some of the seasonal fundamentals associated with live and feeder cattle futures trading. So based on historical data, cattle prices tend to increase just before and during the summer months, but not necessarily because it is prime grilling season. After all, the feeder cattle used to supply that beef were already being priced back in February and March. And conversely, summer is when feed supplies are lower and more expensive. So as we can see, as we work away from spring to summer, the cattle price actually has a rise where it overlaps the dropping feed supplies themselves. We see the overlap here where then as we work into autumn, we have a sharp decline in the price of cattle, where the feed supplies then jump up higher, giving the decline in cattle the somewhat correlation there. The global outlook is good news for those of us that are interested in feeder and live futures cattle trading. The United States Department of Agriculture, which we all know as USDA, estimates that beef exports will increase by more than 2.7% this year. This is mainly because of the potential expansion of markets in Asia. For instance, on May 17th of 2019, the overall CME market surged following the news that Japan was reopening full beef trade with the United States, causing a sharp incline in prices. On the global scene, the production of cattle is forecasted to grow somewhere around 1% this year to 63.6 million metric tons. This growth is driven by Argentina, Brazil, and the US at the top. These top producers and exporters, for that matter, are looking to increase their output to meet growing demand in Asian markets. They're also looking to capitalize on the weather-related herd reduction in Oceania as the anticipated competition in Asian markets is lowered. So with this anticipated rise in cattle supply, it is likely that the cost of feeding cattle will also rise this year, especially as the feeds industry will work to keep up with the higher demand for live and feeder cattle. In conclusion, live cattle futures and feeder cattle futures make it possible for beef to not only be something that we have on our dinner plate, but something that we can use as a way to diversify our portfolio and or increase our overall futures trading gains. Currently, the market has seen a tremendous fall. We watched it fall to extremely low levels as a result of the coronavirus, now exhibiting a very range-bound volatile behavior awaiting the next big move. If you get into the game now, there's a good chance that you might be able to stay ahead of the curve when that next big pop happens. But until next time, thank you for joining me for another Survival Guide episode, everybody. Please make sure to click the like and subscribe button down below, and I'll see you on the next one. Over and out, everybody.